We are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. I'm your host, Pablo Gonzalez. Joining us today is a man of many talents, namely servicing people, rental properties, collectibles, golf, all sorts of things, looking like he doesn't have arms. Very talented in that one. He is our senior account manager, Stewie?
Yes.
Senior account manager, a guy whose face is etched in the JWB Mount Rushmore. Mike Stewart. Stewie, welcome to the show.
Thanks, brother. Appreciate it.
And as always, we got our community manager, Madison, who's going to be hanging out with us in the chat, helping you with anything that you need, anything that's going on, welcoming you members to the community. Madison, welcome today.
Hello, everybody.
Good to have you. Good to have you, Madison. And I can't wait for our growing segment that I'm going to tease in a second.
It's a good one.
Yeah. And, I love that everybody's checking in. Continue to check in here in the chat ahead of the roll call. But we like to tell people, if you're listening to us right now on the podcast or on the radio, it's we're super pumped. I hope you're getting a ton of value and some entertainment and some education, but you're kind of doing it wrong, right? Like you should be joining us live on Tuesdays and Thursdays at 12:30. Go to nyais.com, become a part of the community, get to know us here in the chat, and get to be part of the infamous roll call. You ready for the roll call, Stewie?
Let's do it.
Roll call time. Let's go. Carl Thompson, good morning, everyone from Colorado. John Henning, good afternoon, all. Bill Shields, buenas tardes, amigos. Joanna Bautista says, hello, JWB fam. We got Leo Furaganen saying, good morning, all. Drew Barnhill from Atlanta. Drew, seeking nickname Drew. You're right, Drew. We need a nickname for you. He says, hello, everyone. He's saying, good afternoon. Looking forward to our game Sunday. Lee Bishop, hello, everyone, including Madison and Pablo. Thanks for including me there, Lee. I appreciate that. Who else we got in the house? We got short roll call, Sean Hanna. Good afternoon. David Blattner. Hello, all. David B. from Massachusetts. Wayne T is in the house. Hello, all. Noah Randari is in the house. He says, hello, everybody. It is good to be kicking off with my new favorite segment, which is Madison shares good news. Madison, what you got with good news today?
Oh, yeah, I'm always the good guy. I always got the good news. All right. So today, back to the JWB Cares. Everybody knows that's the nonprofit that JWB does raise money to build houses, to give houses away, which is super cool. If you don't know about it, we'll talk about it. In the last 2 weeks, we have had $1,200 donated to JWB Cares by people putting houses under contract. So just a few of those people made several contributions, but I do want to shout them out. Jonna, Stephen, Justin, Martha, Rick, Sergio, and Timothy and Melissa all made contributions. So those people all were a part of that $1,200 we raised in the last 2 weeks, which was awesome.
I love that. So you want to tell us a little bit about JWB Cares?
Yeah. So if you don't know, now you do know. We have a nonprofit that helps raise money. We go into the community. We do a bunch of different things, but the biggest thing we do is we give a house away. We partner with Canines for Warriors. We give a graduate from Canine for Warriors a house every year. So I believe we've had 3 or 4 houses, correct me if I'm wrong, Stu, given away.
How many is this too?
It's 4, yeah.
4.
I think this year is the 4th. So we gift them to Canine for Warriors. They pick the person who gets to live in the house. So it's super cool because these guys probably wouldn't have had a house otherwise or been able to own a house otherwise. So
love it. $2,500 in a week. Is that what it is? $1,200 in a week.
That's next week.
That's next week.
$2,500 next week.
And how do they donate that? That's when you invest, you're able to just do it.
Yeah. So when you put a house under contract, Stewie and Brandon are super good about kind of reminding you and letting you know it's an option. It's just the thing in the contract you can sign to say that you'd like to give $100 to JWB Cares for every house or whatever. It's completely optional, but yeah, you can also go to jwbcares.org and make donations there as well.
Madison, that is good news.
Love it.
I love it. All right, cool. That's awesome. Thank you, community, for the $1,200. Great cause. I like to say on this show that if you don't like veterans or rescue dogs, you can get the hell out of here.
Right. It's probably an issue.
You don't belong.
Not invited.
That being said, we are here to talk rental properties, building wealth through rental properties. We're going to get into the property of the week in a second. Before right now, Stewie, I just kind of wanted to pick your brain about the macro of it, right? Like I love when we get your team on here, members from the sales team on here, because you guys are in the trenches, having communications with everybody. What is at the top of our current clients, our current, people that are thinking about investing? What are they thinking about the most right now?
Yeah, I think it's probably, interest rates are top of the list, Pablo. We get a lot of questions about, what that environment looks like today. How does it pertain to cash flow? What's coming down the pipe, right? As the feds are making decisions seemingly every month that are going to affect all of us. So I think that's probably the biggest. When you combine that, obviously, with rising prices. I mean, we talk about Jacksonville being a growth market historically, and the biggest driver as to why people are investing here. But then when prices start to go up, everybody gets a little squeamish, right, about it. So it's one of those things where you love it for the properties that you own, right? You hate it for the properties that you want to own. So just talking through, really what makes sense, why we're buying the assets, and really why this is a long-term play. Okay.
The other thing that I wanted to talk about is where's GC at? What's he? Is he at the Masters? I mean, he's infamous for leaving me for golf.
I don't think he's at the Masters. I think he's manager meetings.
Yeah,
I think that's exactly what's going on. So every quarter, all of our leadership with the managers for the different teams get together and rehash the past quarter, planning for the next quarter. Again, we talk about team here, guys, and try to stay, 7 steps ahead of the game to make sure that what we're offering makes sense short and long term. That's where they go to work each quarter. So I'm doing my best GC impression today.
I love it.
We'll give it a go.
You're doing great. You don't have to be GC, just be you.
Okay. Fair.
Yeah,
Pressure's off.
I'm always super impressed by that operational prowess, right? Like someone that's growing a company, like when I try to get our 3 partners in a room and just be like totally dialed in, and the idea that you can be there while the company is running is terrifying to me. But the fact that JWB leadership not only does that with the ownership group every single week, but once a quarter, take the ownership group plus the leadership group, and you're able to not be there for 2 days and everything runs well. And you're able to strategically plan and get it done. It's one of the things that blows my mind as far as like the operational efficiency. As a teammate, how do you guys benefit from that? Do you get the sense that the strategy really gets to be put in place based on this type of stuff?
Yeah, I mean, I think anytime you have some level of autonomy, it empowers you, right? Yeah. I think, one of the things that we're fiercely protective of here is our culture, right? We talk a lot about the teammates that we bring on, the process. And I don't know if you're privy to that, the 77 interviews that you have to go through to be a JWB teammate. It's all by design, right? Because you want people that you love, you care about, that you'll go to war with every day. And regardless of who's in the booth next to you, right, you feel comfortable and confident that day to go forward. So when it's just us running the ship, it's a lot of fun and obviously, pumps us up a little.
That's cool. That's cool. It's empowering is what I hear there.
Yep.
What I heard in what you told me of kind of like what's on people's minds, rising interest rates, rising prices. What I hear is urgency, right? Like, are you hearing like an elevated level of urgency from people? I know that me as an investor who owns 2 and wants to get his 3rd, I've been heavily talking to Gregg about pulling stuff out of my IRA and putting it into rental properties because I want to take advantage of this moment. Are you hearing urgency from people, or are you hearing fear?
A healthy mix of both, honestly, Pablo. Yeah. I mean, I think when we look at the urgency, I think the people that get it and understand what this asset class does long-term and what this city does long-term, there's the urgency, right? For the people that haven't done it before or are fairly new to it and kind of getting their feet wet a little bit, naturally, you're going to have a little bit of hesitancy, and we understand that. But again, that's where, when people buy into, Jacksonville and these properties, they're really buying us first. And I think that's where that expertise, that planning, that forethought to make sure that this will be a wonderful investment. And if we can take the opportunity to teach and coach and educate and give that confidence and take you from the fear side to the urgency side, that's the name of the game.
Teed up like a pro, teach, coach, educate. I think we take this opportunity to teach, coach, educate everybody on a rental income property that is available right now, that is part of the inventory. We're going to magically whisk ourselves away here to 650 Herman Street, Jacksonville, Florida, 32205. Let me know, fam, in the chat how it's looking. I always am curious to see if it's blurry or not. But when you first said, "Do you have Herman ready to go?" I was like, "Oh, we have a guest investor today." But no, we're going to Herman Street. We got a house here that is 245,000, 3-bedroom, 2.5 bathroom with a driveway. It's got a lease for 2 years of 1523. Jen is saying it's looking a smidge blurry. Thanks, Jen. You know what? I'm gonna just make this thing a little bit bigger for my own eyes to see as well.
There we go.
Let's see if this thing settles in nicely. And good looking. What it looks like is a new construction property here that we're seeing in this picture. Rent at, I said the rent, right? The lease estimated at 1523 a month.
Right.
And right here, the conventional financing total monthly cash flow, $51 a month. The estimated conventional financing total ROI, 6.62%. And this is where I usually ask GC, what do you love about this property, Stewie?
I mean, there's a lot to love about it, but I think just the old adage, ready and reliable, right? I think that's probably the thing that I love the most. This is a tenant occupied house. It's finished. You don't have to wait for it. And it's in an area, one of our core neighborhoods that we know well. If you get an opportunity to Google drive this street, I mean, you'll see probably another 10 plus JWB new construction. So it's an area that we know well, we're confident in. And I think when you look at the resident being in place, I believe it's through November of this year, you know, that's proof in the pudding that obviously it's an area that's going to be fantastic for rentals short and long term.
There you go. Okay. So, and it's available right now. Is this new construction? Is this one of these ones that got released from the portfolio, it's another more?
The latter. So with the wait list potentially coming right in the next few weeks, naturally, you know, the guys' leadership went to bat and said, how do we create, you know, opportunities for people now? And we cherry picked from our own portfolio and said, hey, these are wonderful options for you guys. We would still hold them if you know, the environment was different, but obviously we need houses to be able to make available. So this is one of ours. We've had it since the beginning, built in 2017. So when you talk about homes for all intensive purposes, if you and I were out, you know, with a realtor looking at homes and we saw a 2017 home, what would we tell our family members?
It's a new home.
It's a new home, right?
Yeah.
So at the end of the day, it'll act, speak, function, feel just like a brand new construction. And it's something you don't have to wait for.
Yeah, it's kind of the best of both worlds, right? Like as we've talked about these portfolio properties that get let go. I know that normally when you have investors, by the way, I want to encourage everybody, if you haven't been to jwbinventory.com, go there. You can download this thing. You can fiddle with it at home while we're fiddling with it here, and follow along. So it's jwbinventory.com. Madison will share that in the chat, so you can just click on it if you're in the chat. But if you're listening in the podcast and you're thinking about joining us live, you can go to jwbinventory.com and follow along at home. So, 5-year-old home, occupied, already there, kind of has this like best of both worlds scenario. This price point of $245 seems to be kind of in line with what we're seeing these days, right? Like I remember when we started this 2 years ago, we were showing a lot of like 130 to 180. Now we're kind of like in the 2 to 250 range. Is this right around the price point that you're seeing most homes that are being sold?
Yeah, I mean, I think when you look at houses today being, let's call it 180 to 280 is what we're telling a lot of folks. If you're talking to us for the first time, that's real, right? When we look at median price points here in Jacksonville being just over 300, I think 318, 315, right? This caters right to the C-class neighborhoods that we know and love, right? And those price points being below middle income fall right in line as well. So the thing that people have to realize, and I had a wonderful conversation with a couple of current clients this morning that bought a property last year, I think at about 160,000. And they're saying, Mike, I want to stay in the same range. I said, well, wonderful. It's up 30%, right? So, 200 is the new 160, I guess is the best way to look at it. So, with that being said, does it make it any, better or worse of an investment? No, I think the long-term appreciation play, having cash flow where this house is going to pay for itself the majority of the time, all that entire narrative still holds true, right? It's just a little different. So we're trying to prep and again, coach and teach clients and prospective clients to be ready for those slightly higher prices.
Cool. And after we get done breaking this down, you're going to do a little bit of coaching and teaching me in a second. So,
yeah, man.
So
okay.
I hope you're ready for that. Stewie, we like to start here with this estimated conventional financing total monthly cash flow of $51. What does that mean there?
So essentially what we're trying to do is to forecast what a typical month looks like for you as a client. So when we collect all rents, residents happy, we don't have any maintenance items, you've paid your mortgage, your taxes, your insurance, you paid JWB a property management fee, what's left over at the end of the day, right? And that's where the $51 comes in. So it gives you essentially an effective baseline to understand, what a typical month would look like. And then from there, if you're clicking on the tabs down at the bottom, if you get into that analysis conventional, then you can really get into the weeds as far as how we get to that point, and break it down even further.
Got it. And we can do that. We can fiddle with it at home if you download the sheet. I just kind of clicked on it to give a little preview. It's a much more complex spreadsheet. We can get into that if there's more specific questions, but $51 a month, that is your typical month. You are cash flowing positive from day one.
Yep.
Right? Unless there is some kind of atypical expense, like a move out, some kind of maintenance. I recently just went through a little bit of maintenance in my home. I actually forgot what it was, but cost us a couple $100. Right. But that's been the first time that my portfolio manager has reached out to me to be like, we gotta do this in a little bit over a year and a half or whatever.
Absolutely.
Right. So that's just typical month. You're making a little bit of money in your portfolio. As time goes on, what I've learned that we used to not say that I find really interesting is this $51, as your loan gets paid down, eventually turns into this $1,000, $66 per month, which is what your estimated cash purchase total monthly cash flow.
Absolutely. When we talk about this, we talk about really 3 phases as we build out people's plans, and it's a totally different conversation for another day, but you're accumulating first, you're paying debt down second, and then you're ultimately to distribution third, right? So when we look at the difference from a $51 monthly cash flow to $1,066, that's showing you moving through those phases, right? Mm-hmm. Accumulating first, paying debt down second, leading to distribution, which is where everybody wants to be. If we could wake up and have $1,000, $1,100 in cash flow every month, right? We'd all skip steps 1 and 2 for sure.
Yeah.
But the reality is we need to go through steps 1 and 2 to get to 3.
Let's talk about the steps. Accumulating what? Accumulating properties?
Yep.
Okay. So you're accumulating properties. Once you, and if I understand this correctly, you accumulate properties. Once you have, like, for example, I'm trying to get to 3. Once I have 3, then I can look at those 3 and be like, all right, what's the best debt to start paying down to like get that as quick as possible? And then once you pay down the debt, be it through, like strategically doing it or over time as
Additional
your
cash flow. Absolutely.
Yeah. Mm-hmm. So like the option is number 1 is your resident is paying your debt down no matter what is happening.
Absolutely.
Right. And then I also have the option to take the extra $51 and put it towards the mortgage if I would like as well.
Yep.
And pay down quicker. That's the second phase. And then once stuff is like significantly paid down, now you're swimming in cash too, plus appreciation, plus whatever.
Right. Exactly.
I like that, man.
And the cool part is, Pablo, what happens to the $51 over time?
What happens to it?
It's going to go up.
It goes up.
Right.
Yeah.
That's the beauty of having fixed debt in an inflationary environment. So that's the thing. I think when people look at this, especially when we flash forward to the future, right, and we get interest rates at X and prices at Y, we'll get to a point where we're probably cash flow neutral, right? And I think a lot of people get it in their minds that that's not a wonderful investment, but at the end of the day, it's paying for itself, right? And that's where we start. Yeah. It's going to go up from there. So even into the future, I think we've still got a lot of opportunity.
Yeah, I believe that, man. So let's talk about that. So then that's the cash flow sector. That's the typical month. But then there's this total ROI financing, conventional financing total ROI 6.62%. What does that include?
Correct. So everything but appreciation. So oftentimes when I'm talking with clients, we'll talk profit centers, right? The 4 or 5, right? However you look at it. When we look at what we track, what we build into these spreadsheets, it's the 4, right? And we intentionally leave the appreciation out. So when you're looking at 6.62, that's going to be your net cash flow. So what we talked about with that $51 a month, it's going to be your principal pay down as your residents essentially are making those mortgage payments for you. Part goes to principal. We want to count that. And then you're also going to have your tax savings or your standard depreciation, which we factor in as well. So kind of that under promise, over deliver pod, right? As we look at it, it's really just a wonderful way to say, hey, if we get the appreciation on top, everybody's going to be real happy. Let's hold ourselves accountable to the things we can control.
Did you just uncover an acronym for under promise over deliver? I had not heard that yet.
Internally, we've dropped a couple of UPOD bombs along the way. Absolutely.
UPOD, under promise over deliver. I like that. I think that's good swag.
That's it.
Right? Like
hats,
UPO.
right?
Yeah. I'm in, man. I'm in. All right. That was a first on the Not Your Average Investor Show today. Speaking of firsts, Jen Filsden is saying in the chat, not sure if you were all on the Tuesday show, but our community decided to put together an online game this Sunday, which I think is really, really cool, where they play the cash flow game, that Robert Kiyosaki, Rich Dad Poor Dad cash flow game online. For details, you can check out the Facebook event that she created. You can reach out to Jen in the chat. You can reach out to Jen in the Facebook group. She shared the link in here, but I think it's really cool that we're going to have our community is going to start playing some online games. I don't know, just came out of nowhere.
Kudos to you guys. I mean, the meetups, the online stuff, it's amazing how we can be connected yet so far away at the same time. So wonderful stuff.
It's amazing. It's amazing. So, all right. So you're talking about the total ROI. You said the 4, maybe the 5. You want to just kind of run through the five profit centers of property investment?
Wherever you're looking at a property, if it's in Jacksonville or Memphis or Austin, Texas, wherever it may be, right? There's 5 ways that you're making money on that property, right? The first is your net cash flow that everybody knows, and that's kind of what we all have intrinsically been trained to gravitate towards. The second is going to be your principal pay down if you have a mortgage in place. If you buy cash, it won't apply. Third is going to be your tax savings or your standard depreciation on the property. Fourth will be appreciation, right? What's the house growing at relative to its surroundings? And then the fifth is going to be the inflationary hedge, which is harder to quantify, but you can actually see it on the spreadsheets. If you get into that analysis, conventional financing and get into it, it's definitely present. So when we look at what we track, not only on the front end with these pro formas, is we try to paint the most accurate picture we possibly can for you, but we also follow it up with the ROI tool on the back end that all of our clients have that's custom, that takes this pro forma and essentially acts as an extension and tracks those profit centers as we go forward.
Love that, man. I mean, I know that as I've been on this journey and learning about all of this, it's like cash flow, everybody gets that. People value it differently, right? Like the Jacksonville market is not where you go for cash flow as much, but it's still positive cash flow. So
absolutely,
you're still making money every single month in the bank. It makes it a scalable investment is the way the GC likes to talk about it, right?
Yep.
Because you don't have to come out of pocket. The debt pay down, I love, right? That's what Tim Hicks for the first time on the show called worst comes to worst, your resident is paying down your mortgage. And that's a way to accumulate
very
wealth.
simply put. Yeah.
I love that. Depreciation, tax savings is what you talk about it.
Mm-hmm.
Explain to me depreciation a little bit.
So depreciation essentially says here with Herman Street, right? If we look at this at $245,000, right? I've got a building sitting on some land, right? In theory, land is going up over time,
Mm-hmm.
right? And a building, if we didn't do anything to this building, right, it should fall to the ground. It's just a matter of time, right?
Yeah.
So then the IRS tries to quantify what that matter of time is, and they happen to stick 27 and a half years to it. So they say that you basically can take the value of that building and write it off against your taxes for the next 27 and a half years. So we use a 30% tax bracket. The challenge is I don't know what your tax bracket is. It's different than mine, different than Madison's, different than GC's, et cetera. So we factor in 30, which is kind of the middle of the road. But again, when you guys get into these spreadsheets, they're all formula driven. So if yours is higher, if yours is lower, whatever it may be, plug it in, and then you can see the changes to the ROI real time.
Interesting. So I still haven't done my tax return, but I'm actually really looking forward to it because I acquired those 2 properties last year.
It's going to help.
But I'm essentially going to like make money on the fact that I was going to have to pay these taxes on the income that I have. It's going to get offset by this depreciation. And that's a profit center.
Well, 2 different things. So when you're talking about the expenses that I have relative to the income that I have, right, that's those 2 offset each other.
Okay.
So you don't create a taxable event with your passive income.
Okay.
What we're saying here is with the standard depreciation, right, if I'm writing this off relative to my big picture tax scheme, not just my passive income, right, but big picture, I'm essentially reducing that liability independently of my income versus expenses, Pablo. Does that make sense?
Yeah, it makes perfect sense. Is that, what is it they call that? Like a non-cash event or something like that? What is there's like some kind of term.
Non-taxable event. I don't know what they call it.
Like
where it's neutral, where they offset each other. That's as much CPA as I get.
Deal. All right. And then finally, we talk about, that was depreciation. Now let's talk about appreciation. Why is it 0% here when we know that this market's on fire?
It's because it's going to be the most unpredictable of the four profit centers, right? When we look at, consistency, it's easy to outlay what standard depreciation is going to look like, right? And that's going to be very consistent. We know an amortization schedule for our mortgage being paid down that we can dial up to a T. Cash flow, a little bit more variable, but we've got a lot of experience, a lot of historical data. So we feel like we can be constant there, but we don't have a crystal ball. So we can't look up and say, how much longer is Jacksonville going to continue to be on fire, right? We don't know that. But while it's on fire, obviously, let's take advantage.
Yeah.
And we know what Jacksonville will do historically. And that's the neat thing is when you go to the markets and you've got teams that are very experienced in these markets, they can look at the historical trends. They can go back and say 4.6% since 1982, right? And know what this is going to be relative to the other investments in my portfolio. So while we know that it's there, while we know that it's our differentiating factor or one of them in our markets, right? It's not one of those things that we go screaming from the mountaintops. We'd rather have it be that pleasant surprise at the end of the day.
The U-Pod.
The U-Pod.
Under promise, over deliver. I love that. Yeah. So then I guess the way that we've explained this in the past, I'm glad we haven't done this in forever. So I'm super pumped we get to do this. But this idea that if you're holding on for short term, it's impossible to predict, right? Because you don't know what it's going to do year to year. Right now, it's what? Like, where's appreciation rate right now in Jacksonville?
I think we were 19% year over year in January.
All right.
Yeah.
Man, that's awesome.
Mhm.
I'm really glad I bought last year. And it's continuing, right? Like that is like what you're buying today, you're buying into kind of like that performance right now.
Yeah, we looked at projections at the beginning of the year and felt like 15 plus was very real. So, we're a quarter in. That means we've got, another what, 11, 12 to go, essentially, as we look at it.
Yeah. Wow. That's super interesting. So then you don't put 15% in there because that's nuts. But,
Exactly.
Over 30 years, it has historically been proven to be 4.6%. So you can think that if you're going to hold on to for the long term, you put this in here, 4.6%, and it goes from a 6.62% ROI to a 24.21% ROI. You want to explain this kind of crazy jump here in ROI?
Yeah, first of all, that's why people are buying houses, right? I mean, when we look at that, if we have to divide the pie four ways, essentially, and we had 6 before we started with 3 pieces of pie, and now we've got 24 with 4, tells me I'm going to have a huge piece of pie in the appreciation cap. So when we look at that, though, the key is with leverage, especially, right, is that I'm getting appreciation on that whole house, but how much did I have to put into it? 25% down, 30% down, 20% down, depends, right? So if I have marginal skin in the game, but I'm getting to participate in the whole thing, right, then that's where the leverage becomes very, very powerful. And that's why people are buying houses here. So when you look at the majority of our clients, probably pushing 80% use leverage. Yeah, that's exactly why.
Yeah, that makes sense. I don't think anybody's ever put it that clearly. That is why people are like, that's why I would want to buy a house, right? Like when I'm telling, I was talking to my dad last weekend, I'm trying to get him to invest in this stuff. Still not good enough to convince him because he's old, right? Like he's like, I'm 76. I need cash. Anyways. And by the way, he doesn't see me as the guy that's going to give me financial advice. Let's just be real, right? It's like I've made more money than you. Yeah. So as I'm looking at it, I'm just like, yeah, man, this to me, this 24%, right, of this like leverage, this idea that I'm only putting in 1/5 of the capital, but I get the appreciation on the entire valuation of the asset when you're using this smart leverage, and this idea that this like relatively, you can count on this thing 24% if you're sticking in for the long term in a asset class that's pretty low risk because you've got a team that's got this thing figured out in a market that's really, really working really well. And this type of return to me is what makes it different. I was talking to him about his portfolio. And he's like, I got these 3 buckets. I got like the cash flow that I live. I don't know why I'm doing this.
This is good.
But just so you know, it's not me talking.
Right.
He's like, I got this cash flow that I live in, that I live off of. I got this like middle thing that like, if I need the cash flow, I pull from. And then I've got this like long-term safe thing that I'm expecting different things. And I'm like, how much are you expecting from each different bucket? And he's like, well, maybe like 3 to 4% on the middle one and maybe like 6 to 7% on the high one. And I'm like, why wouldn't you do this?
Right. For at least a portion.
Yeah. That's what I'm saying is for a portion,
right?
Like if you have this like long-term piece that you would love it if the stock market gives you 11%. You'd love it. Why don't you just take some of that and put it into this 24%?
Yeah, absolutely. And I've even, heard folks refer to it as, buckets of gotta have and want to have dollars, right? So let's protect with reliable asset classes that are consistent over time for the dollars that I absolutely have to have, right? If I'm talking about house payments and, medical insurance and things of that nature, cover that. And then you can be a little speculative with the others. But I think when we look at that gotta have bucket, right? I think that not have real estate in it would be, foolish for a host of reasons.
Yeah. There you go, Dad. You're being foolish.
Cool.
All right. So Raj Bantu's got a question here in the
Sorry,
Q&A.
Dad.
Sorry, Dad. Raj Bantu has a question here in the Q&A. He asks, mortgage rates went up rapidly to around 5% on 30-year fixed. As the interest rates go up, housing demand goes down. It seems housing started to slow down in some parts of the country. What is the forecast for housing in Jacksonville in the next 1 to 3 year horizon? Stewie, let me start off by asking, is that a fair question?
Yeah.
Okay.
Yeah, I think it's real. Just the statement that as interest rates go up, housing demand will go down is 1,000% true, right? It's healthy, it's normal, it's expected. I think if we continue to run at this pace for 5-7 years, right, you're going to have a host of other issues to kind of uncoil. So I do agree with that. I think the one thing that it's changing is the population growth, right? When we talk about the number of people here, right, coming, if we go from 900 people a day moving to Florida to 750, right, it's not really going to put a dent in it. And really the bigger thing is that we just don't have houses, right? And we don't have houses and we don't have a way to deliver houses in the ultra short term. So I think when we're talking 1 to 3 years, even if we get a bump in interest rates, it's going to affect affordability to a certain extent. But I think you still have a ton of people coming here and not enough houses for those people.
Yeah, that's really well said. We are experiencing all these like macro tailwinds of people moving to like warmer climates, right? Like the idea that work has gone virtual, so you don't really need to live in Sandusky, Ohio.
Right.
The idea that people want to live in low cost living places. We're still below the national average in cost of living. The idea that everybody wants to live close to the beach, right?
Right.
And all that stuff is coming at, not to mention the economic sector booming, right? Like the smart cars and the tech sector and the healthcare sector, the logistics sector that is in Jacksonville that is really, really stable, attracting people like me, all these different things. And the housing supply isn't keeping up, right? So there is the interest rates, all else equal, interest rates going up is going to bring housing demand down, like buying housing demand down. But people moving here, not enough houses. And at the end of the day, we're talking about rental houses. Wouldn't interest rates going up and housing demand going down increase the desire for people to rent?
I think to a certain extent, it'll all depend on your median wage growth, right? So if you're attracting the right folks, and that's where when we talk about vertical integration that GC loves to pepper in, which makes total sense, not only from a business, but we're trying to push median incomes here by making Jacksonville a desirable place for people to come to. Yeah. But then when those people are coming, if they're high quality folks, right, then businesses follow and say, hey, the people are going here. And oh, by the way, it's very affordable. Why wouldn't it make sense for us to go? And that's what you're starting to see as well.
Yeah. And I think there's also the idea that in these like C-class neighborhoods that we call them, right? This idea that these are the homes for people that work blue collar jobs, like in the military and in schools and very, very stable environments. This housing sector, the specific housing sector in which JWB plays in, is always going to be demanded, right? Like there is no way to scale down from this that is still like a suitable place to raise a family.
Absolutely. All of those people that are coming that are higher wage earners, right? The businesses that chase them, you're going to need that blue collar community to be able to support that growth and the services that they're looking for. So yeah, I think one hand feeds the other for sure. Yeah.
So then in his, what was the actual question? The actual question, next 1 to 3 years, the forecast for housing, if we can succinctly explain that. next 1 to 3 years, there is most likely still going to be a surplus of demand for housing based on the supply that's able to come to market.
Agreed. Yeah. The people are moving here for politics, climate, and taxes, right? Predominantly, if you had to label it as three. So I don't think interest rates are going to change any one of those three variables. So as long as the people are continuing to move here, in my opinion, right, then they're going to need homes. And if builders today decided that they wanted to dump 40,000 homes into the Jacksonville market tomorrow, can they do that? And the answer is no, right? There's too many headwinds as far as, supplies and labor and permitting and all of that fun stuff, right? To get through that. So I think when we look at the shorter time frames, it's easier to answer that question. You get north of 3, 4, 5 years, then there's some variability there.
Yeah, makes sense, man. So let's talk about the implications of all these things, right? First of all, is that a question that you're getting a lot right now?
We get a lot about Jacksonville. Absolutely. Yeah. I think, when we talk to clients, it's you're buying a team, you're buying a market, and then you're buying a house. So I want you to be 1,000% comfortable and excited to work with our team and excited about Jacksonville. So we do have a lot of questions about that, especially in situations where clients or potential clients are looking to invest in us versus other markets, right? Tell me why Jacksonville is better than XYZ city, right? And we get a chance to really lay out why we're passionate, why we really believe in this city, and we think it's going to be a wonderful investment for the long term.
Why is that?
Because of the growth, baby.
Because of the growth. Yeah. Because of the growth.
Yep.
Okay. So then, by the way, if you are curious about the Jacksonville market, we are having, I forget, I'm trying to figure out what date it is, but the client and the investor tour that's happening in June here.
End of June.
Like
23rd-ish, somewhere in there. That week, whatever week the last week in June is.
Yeah, I'm trying to look it up as we're having the conversation, and I'll get it right. But like, we are having an IRL in real life meetup here in Jacksonville, where the clients that are going to check out their house is cool. And we're also going to do a tour of downtown and all the different things that are happening downtown. And, the interesting about why don't you tell us what's the interesting about Jacksonville downtown when it comes to rental property investors like ourselves?
It's going to be the catalyst for growth for all of the communities that we've focused on for the last 16 years, right? I think when you make Jacksonville downtown a viable urban core that is a destination, right? Then you're, again, bringing more people, you're bringing more jobs. That grows the communities that lie in and around that. And when you look at the 4 core areas that we've focused on, it's no shocker, right, that they're right around the downtown area. So it's a boon for the city, because I think, as we look at Jacksonville getting all grown up, right, we want to make sure that it's a viable downtown for that purpose, to take Jax as a whole to the next level. All of the investors in those areas around it are just going to stand to benefit.
Yeah, which to me is the kerosene on the fire, right? Because the big secret is, and you'll see it if you come June 24th, by the way, Jen Filson, fairy godmother of the Not Your Average Investor Show community, just clarified in the chat. June 24th is the fact that this is a big booming city and the urban core has yet to really blossom.
Yeah.
And when urban cores blossom, it's this big windfall of like real estate values and economic opportunity and all these different things. And if you take this tour with us, which we've now done a couple of times, you're going to realize that it's right there. Like, it's like right at the tipping point. It's got a bunch of waterways. It's got a bunch of like public things and everything that's happening around it. Once you see the vision for it, it's real.
It's gorgeous. When you guys think of the top downtown destinations that you could go to in the country, right? You think of Austin and Charlotte and Chicago and San Antonio. Even I had the conversation the other day. We had some friends that were down at the Riverwalk, right? There's no reason we can't be that, and then some, for sure.
Yeah, totally. I lived in Miami, right? Like, I know that 15 years ago, if you went to Miami, downtown kind of sucked.
Right.
And you go to Miami now, downtown is like as dense as Manhattan. And like real,
so wild.
Like it's insane, right? Like, it's just like nuts. I always like to talk about, the movie Bad Boys.
Yeah.
The first Bad Boys.
Absolutely.
If you watch the first Bad Boys, it's like 93. There's like 2 skyscrapers when you see the scenes. And now
I'm gonna have to go back and look at it.
Go check it out. It's comical. All right. But like, it happens fast. And I lived it and I saw the windfall of real estate values, which is one of the reasons why I'm so bullish here in Jacksonville. All right. So that's the market. Interest rates, man. What's going on there? What do we need to know? What kind of questions are you getting around that? And like, what's your best advice?
I mean, it's the reality, guys. I mean, it's the new normal, right? Yeah. When we talked about 200 being the new 170, or 200 being 160, whatever I said earlier about the pricing.
Yeah.
Same thing with interest rates, right? I mean, we've seen, rates go from, sub 4% at the latter part of last year, where we're seeing 5.25 pretty consistently, 5.5 right now. So when our clients are kind of trying to navigate that, right, I think the most important thing to understand is that you've got options. And when you have options, that's powerful, right? So, whether you decide that, this is a possible refinance play in 5 years, and I'm going to just take the rate where it is and roll the dice that it's going to be better or the same, then you can go that route. We've got a lot of clients that are exploring the opportunity to put 30% down, right? Because it bumps your cash flow, to be able to give you a little buffer in the interim, which makes everybody sleep a little bit better at night. But it also will buy your rate down typically, because if you're putting more money down, less risk to the lender, right? Because you have more skin in the game. So you're typically going to get a better rate. The other thing that people have been doing is just exploring the opportunity of pain points. If this truly is a long-term play for you, right, at bringing, 0.2 points, 3 points to the table at close to buy it down to a rate where you feel like, man, this is an opportunity of a lifetime, then go for it. But I think for each client, it's different. Some clients are ultra cash flow focused. Some clients are ultra ROI focused. And we need to just find options that work for those folks. But I think the key is to know that you have them in the first place. And you don't just have to take the rate as to where it is. You can manipulate it to your favor.
What does pain points mean? Like, I've heard that all the time. I'm not a sophisticated investor like you guys. What does that mean?
Yeah. So when somebody originates a loan, right, they'll look at kind of what the market is doing, very much like fixed income, right? So if today the rate is at 5.25%. So if I didn't put anything down, that would be my going rate, right? Now, naturally, if I bring additional dollars to the table to help pay essentially for part of that loan expense, then I can take that rate from 5.25, maybe down to 5 1/8, or maybe down to 5. So a point is just literally 1% of the loan amount. So, if you got a $200,000 loan, a point is going to be $2K, right? As we look at it. So with a lot of our houses, again, being that 180 to 280, 2K is probably about average for a point, I would guess, on a lot of our properties, depending upon how much you're putting down.
2K means I'm just like cutting the bank a check for 2,000 in order for them to bring down a point.
Right.
And that's different than just putting down 30% in order to get a lower interest rate.
Correct. So what happens essentially, if I pay 2 points, right, and I give $4,000, okay, that's a cheap way to reduce my rate, but it does zero for my payment and my cash flow, right? If I put 30% down, it helps my cash flow and I get a better interest rate. So oftentimes when people are faced with the two, right, the question is which is cheaper, right? Points will be cheaper, but it doesn't help my cash flow. 30%, if I have the capital, absolutely makes more financial sense to put down in that particular situation.
Buddy, that's the first time anybody has ever explained that to me, and I finally understood it. Thank you.
Love it.
Because I've heard that all the time. Like, oh, you pay points and blah, blah, blah. It seems like such a smart guy thing to do, and I have no idea what it is.
Yeah.
So now I know what's going on. All right, great.
Cool.
So that's interest rates. What about price points, man? We just said it, right? 200 is the new 160. We're appreciating at like 15%. So next year it maybe like 215 is going to be the new 160.
Yeah. I mean, I think if we're looking 180 to 280 now, right, if I tack another, even 10% on top of that, then it's probably going to be 2 to 310, right in that range. But the key is to look at it relative to median, right? I think that's when, we look and say, man, this house is 245,000 and I paid X for it last year, right? Well, tell me what's happening in big picture, right? Because oftentimes, clients own homes here already, so they've received that benefit. Yep. But at the same token, you have to kind of take your medicine and make sure that you continue to get in. The question is where do we go from there, right? I think a lot of people are talking about, the possibility of a recession happening, which we've kind of debunked that myth in the past with, looking at the past 5 recessions and how that correlated with real estate, specifically here in Jacksonville. And 2 of the 5 were down. 1 was down, I think 0.98%. So it's really flat for argument purposes. So I don't believe that that's going to happen in the short term. But again, could it happen in other markets? Absolutely. I think every city is going to be different. And that's where having a team that's in tune with what's happening, boots on the ground, is so critical.
City like Cleveland that already has a negative growth rate, the chance of a recession happening is,
if finances get going squirrely, right, and a bunch of people are leaving town, it's going to be painful for a bit, right? But if everybody's going to Jacksonville, then
Correct.
it's a
They got to
different
go
situation.
somewhere. They're not all leaving the US.
Correct.
They're
Correct.
just moving to warmer climates and,
Yes.
and we're one.
Yep.
Cool. I'm into that. And, GC asked that I make fun of Cleveland at some point while he was
That's
here. So,
fair enough.
So we got it.
Check.
And then wait lists and timing. Tell me a little bit about, if somebody wasn't here for the client only call or anything like that, give us a little bit of context on what's going on there.
Yeah. So essentially, guys, we just looked at the way that we were putting homes under contract, right? And over the past 18 months, we would put homes under contract as long as the vertical phase of the build had started, right? If we had a slab poured, we'd let you guys put it under contract, which worked probably 70-ish% of the time, right? And the 30% that it didn't, it was painful, right? For those clients that had a delay for, labor or supplies or permitting or whatever. We did the right thing by them and kept the prices the same. So they did really, really well. But at the end of the day, that process and that client experience wasn't ideal. So we went back and looked at it and said, how do we change that? How do we make that better? Because we certainly don't believe that the environment is going to change, right? We're not going to wake up and have tons of labor and lumber and things of that nature. So we need to adjust internally. So what we did is we said, hey, let's sell things or put things under contract essentially that are going to finish within 45 days or are already finished. And in doing so, obviously the client experience gets a lot better. But at the same token, we take the pool of homes that we could, allow people to put under contract from this to this, right? So it doesn't mean that they're not coming. It doesn't mean that they're not there. It's going to be a little bit more channeled as we go. So this whole concept of a wait list was brought up because we're going to hit that realistically here probably in the next 2 weeks, if I had to guess, right, as we look at it. So we're kind of getting to that end stage. And then it's just going to change the way that we do business. So I think oftentimes people think about a wait list and get a negative connotation, right? But the reality is that this is going to be better for everybody at the end of the day. We just need to be a little bit more strategic, a little bit more calculated on how we plan and how we prepare to acquire properties for the remainder of 2022 and beyond.
Jack's got an interesting question here in the chat, and he's asking, would you still be able to accommodate a 1031 exchange?
It'll all depend on timing, Jag. So Jag is wonderful because she was actually right at the beginning of 1031s and us having the conversation of, what pushed the deadlines, because with 1031s, if those of you haven't done one before, you've got 45 days to identify, you've got 180 days to close. If we're trying to accommodate construction and financing and this, that, and the other, it can get dicey. And the last thing that we want to do for you as clients is to cause, a massive taxable bomb to blow up, right?
Yeah.
So at the end of the day, it'll be case by case, Jack. So we'll watch it as we go. But I think if we have properties that fit what you're looking for and you're ready, absolutely, it's something that we can still entertain.
Better right now to pull the trigger on a 1031 than later, right? Like the chance of you being able to do it right now.
It's going to get harder, right?
It's going to get harder.
Yeah, absolutely.
Yeah, like all things. So it's like urgency is increasing is what it seems like.
Yep.
Are people, to add a little context to the waitlist situation, like it's weird for us to talk about it on the show because we haven't had it for a very long time.
Yeah.
But I don't know what happens outside of this show. This is my world right here. And that's it. When you're talking to people, are they coming from places where there's a wait list? Are there other people that don't have a wait list? Like
I think
how common, uncommon is it?
We're the last one, to my knowledge, to not have one.
Interesting.
I mean, you've got wait lists, you have certain companies that are putting their clients in bidding war types of situations. So when the houses do come available, it's you versus me, Pablo, and whoever bids higher.
I wouldn't want to do that.
Yeah, I wouldn't either. We both don't get a house, right? We're done. So at the end of the day, I think this is reality. And when we've been talking to current clients and potential clients about it, I think it's just the reality of the national landscape that we're seeing, because again, the supply, the labor, et cetera, it's not localized just to Jacksonville. Everybody is experiencing that to a certain degree. And I think us having new construction and renovation options have allowed us to get to this point, stave it off a little bit longer than most. And hopefully, as we go, we're going to manage that wait list better than anybody else as well.
And first of all, I want to acknowledge the chat. I feel like there's been like all this really great exchange between Denny and Drew and Jen and Jag and all these folks here in the chat. That seems to be a lot of great advice being given back and forth that I'm not really able to like keep up with because I'm trying to keep up with student.
It's flying.
But it's amazing, right? Like I love the community aspect of the show, the shared knowledge, inside the community is steep, right? Like it's deep.
Yeah.
How would I just can't imagine. I feel like your job right now of like making people feel comfortable and selling this asset and getting them into a home, you know, the other sales folks, when JWB has homes and other places are all on a wait list, like being the last bastion of like not having a wait list, how could they even sell? I'm wondering like who gets in a wait list for somewhere else when JWB has like what drives the decision on a consumer to be on a wait list somewhere else and not here?
Yeah, I think a lot of the competitors that we're up against, Pablo, they're lower price point markets. They're Cleveland,
Okay.
right? So if somebody wants to buy a house for 100 grand,
Got it.
I can't do it,
Got
right?
it. So I can come up with 20 grand, but I can't come up with 40 grand.
Correct. Capital tends to be the bigger driver
Yeah.
as we look at it. So, and that's the benefit again of being in a growth market. It's just a different animal, right? So again,
Yeah.
just prepping people for that accordingly as far as our purpose and how we can fit into their overall plan is huge.
Awesome, man. Well, this has been anything else, Stewie? Anything else that we haven't hit on that you'd love to get off your chest that you think could be useful?
No, I mean, I think just keep talking to us. I think one of the neat things is with a team now of, you know, us pushing 100 folks, we've got a lot of talented, educated, connected individuals in the building, you know, that are wealths of knowledge for you. So if you're a current client and it's your portfolio manager, right? If you're a prospective client and it's myself or Tiara or Brandon or Madison, right? We're happy to jump in and share that knowledge with you to really see if this is going to be the best fit. And if it is, we'll be off to the races. If not, that's okay, right? We want to find out early on in the process so we can get you to the best spot possible.
You know, that's something that really crept up on us, man. I remember saying 85 for a really, really long time. And it all of a sudden jumped to like a team of pushing 100, right? Like that I became aware of that this morning running with Gregg.
I don't know if it's over 100. So we send out whenever somebody comes new to the team, if it's a new hire, if it's a new client, we want to just kind of love on everybody. So we'll send out a big email welcoming everybody to the team. And when I sent out mine this morning, we were at 102. So I don't know, maybe we got a couple stragglers in there, but regardless, we're right at that 100 mark. So it's crazy. When I started, we were less than 40. So that's wild to see it happen.
Yeah, you've seen it grow, man. That's really, really cool. Stewie, I appreciate this time with you, man. Like I think you really knocked it out of the park. You made a lot of stuff easy for me to understand that I had not figured out yet in 2 years as host here. So I thought it was really awesome, man. I really appreciate that.
Yeah, no, thanks for having me. It was fun.
Yeah, and if you are listening on the podcast right now, by the way, go back and check out Justin Donald's episode. I thought that was really, really awesome. Dennis Shapiro's before that was really, really good too. So check out the podcast, check out the past episodes. There's been some really good stuff being shared. And if you are listening on the podcast,
tune in live.
Just do yourself a favor. Just go to nyais.com, register once, put it on your calendar, and just one time, make time for this. I promise you're going to keep coming back like Drew does, like Denny does, like Ken does. Like Jen does, you know, our usual community, you're going to love it. And because of that, I have to thank the community, right? Like you got 30 plus people here chatting away, helping each other out, about to play online games this weekend, getting together in Seattle, getting together in Denver, getting together in Los Altos, California. You know, if you didn't take an hour out of your day to spend some time with us, this thing wouldn't be real. So I'm just really, really, really grateful to everybody. Thank you to Madison for being an awesome community manager there in the chat. And
thanks, y'all.
Say goodbye to everybody.
No, we appreciate you. I want to know who wins the cash flow game.
Oh, I thought you were talking about the Masters.
We got to find out. No. I want to. Yeah,
you're gonna know that,
right?
Yeah, let's find out who wins the cash flow game. And until next time, do not be an average investor.